What's up, guys? Welcome back to the channel. So we've received several economic reports that are giving us a clear picture of what's been going on in the housing market and the broader economy. Today we're going to be breaking down inflation, housing inventory, the job market, and why reverse mortgages are becoming a bigger topic for homeowners. By the end of this video, you're going to be understanding what these developments could mean for mortgage rates, home prices, and your next real estate decision. So let's start with inflation. You're going to see here on your screen, you'll see that Zillow has the CPI shelter forecast for 2026 or for May 2026. And so according to Zillow, inflation, the latest inflation forecast, housing related inflation continues to cool, but it's happening more slowly than many economists have expected. Inflation, shelter inflation includes rent and housing costs remains one of the highest components of overall inflation. So why is that important for you guys? It's because the Federal Reserve is still watching inflation closely, and the Fed's goal is to get inflation back towards that target level before making any significant rate cuts. So the good news is that inflation continues to move in the right direction. The challenge is the housing cost remains somewhat stubborn, which means the Federal Reserve may continue taking cautious approach. For mortgage rates, that suggests that while mortgage rates could gradually improve over time, we're probably not going to see a dramatic drop. So we're going to be talking about the housing inventory as of now. And then you're going to see here, so new listings have fallen 1.3%, one of the biggest weekly declines of 2026. Okay. And so what that means in simple terms, there are fewer homeowners putting their homes on the market for sale. So there's several factors here coming into play. Many homeowners currently have mortgage rates between 2 and 4%, from the refi boom or from the purchase boom around, the early 2020s. So many homeowners still have that rate. And if they sell their home and buy into a new property, they may take on a mortgage rate that is closer to the market rate, which is closer to 6 or 7%, depending on where you're at. So that creates, many experts call like the lock-in effect. They don't want to move because of how cheap their mortgage is. They know it's going to probably go up a little bit, from where they're at now, especially if they've paid off a few years. A lot of people don't want to stay. A lot of people don't want to go ahead and get a new kind of mortgage. So economic uncertainty is also at play here. It's causing some homeowners to stay on the sidelines. And as a result, the housing market with limited inventory. So many people assume that buyers are slowing down, that housing prices must fall, which is not always the case in this scenario. So when inventory still remains tight, it can help support home prices, even if demand isn't as strong as if it was during the pandemic. So this is one of the main reasons housing markets continue to show resilience despite having higher mortgage rates. So with that being said, we're going to go into the labor market. All right, guys. So taking a look at the employment trends, the index from Wall Street Journal here in May 2026. So what we're looking at is one of the lesser discussed reports that came out this week in the employment sector. So recent data suggests that the housing market may be beginning to cool down. Pretty sure a lot of you guys have started to notice that. If we're talking about massive layoffs, we're not talking about massive layoffs or recessions. Instead, we're seeing signs of hiring activity slowing down, and the job market is becoming less aggressive than it was over the last few years. So why it matters? Because the Federal Reserve is a dual mandate: price stability and employment. So if inflation continues to cool while the job market softens, policymakers may become more comfortable reducing interest rates later this year. And historically, softer employment data often helps bonds markets, and mortgage rates tend to benefit when investors believe inflation pressures are easing. This is one of the reasons mortgage professionals pay such close attention to employment reports. So now switching gears into a topic receiving increasing attentions lately, which is reverse mortgages. And so you're going to see here reverse mortgages from CNBC Select. As homeowners are aging and retirement costs are continuing to rise, many seniors are actually looking for ways to access the equity that they've built over the years. For some retirees, a reverse mortgage can provide additional cash flow without requiring monthly payments here. And for others, it may not be the right fit. It's not a box that everybody can tick. The key takeaway is that reverse mortgages are becoming more common part of the retirement planning conversation because many homeowners have significant equity but are facing higher and higher living expenses. As always, education is critical, and before making any financial decision here is you should definitely consult with your tax professionals, your financial advisors, see if this is something that you can possibly take advantage of. Homeowners are continuing to look for ways to navigate these higher costs. Taking all these things together, these developments suggest that mortgage rates may gradually improve if inflation continues falling and the job market continues cooling. However, the housing market is unlikely to have a sudden collapse. For my buyers out there who are waiting for the perfect interest rate, that could mean missed opportunities if housing prices remain stable or increasing. For sellers, limited inventory may help support your home values. And for homeowners, understanding the economic trend can help you be more informed and make better decisions, whether you're buying, selling, refinancing, or accessing your home equity. So I'd love to hear your guys' thoughts. Do you think mortgage rates will fall below 6 by the end of the year?